You may have heard these 5 lies about investing so many times that they've been drilled into your head. But guess what? These are actually some of the most common money mistakes that people make, especially when it comes to dealing with their own finances. In this video, we're going to look at the top 5 myths about investing so that you can avoid them. Hi, guys. If you're new here, welcome to Financial Tortoise, where we learn to grow our wealth slow and steady. The first myth is that investing is only for the rich. This is probably one of the biggest lies out there because it couldn't be any further from the truth. It's no secret that having more money does open up more opportunities for faster growth. But just because you don't have a lot of money now doesn't mean you won't have the opportunity to build wealth in the future. With today's technology, almost anyone with an internet connection can invest in stocks, ETFs, and even cryptocurrencies with as little as $1. In fact, apps like Robinhood have a lot of great features for beginners and allow you to buy fractional shares. So you can start investing with whatever you have. This allows investors to take advantage of dollar cost averaging, which means that you can buy small portions of a stock over time instead of buying everything all at once. For example, let's say you wanted to buy 1 share of Berkshire Hathaway. As of the recording of this video, 1 share is trading around $396,000. But if you had started buying just $25 worth of this stock every month since the beginning of 2016, you would have bought 0.05 shares each month. That means that after 6 years of doing this, you would have built up enough shares to equal 0.6 of a share. Now the value of that share might not seem like much, but if you continued to buy $25 worth of Berkshire Hathaway each month, your total investment would be around $18,750, and the value of your 0.6 shares would be around $23,760. And if you had just held on to it since January 2016, you would have made a profit of around $5,000. Yes, this is a very simple example, but it proves that you don't need to have a lot of money to get started. If you can afford to save $25 a month, then you can afford to invest $25 a month. Myth no. 2 is that investing is too complicated. This is another lie that could not be further from the truth. Sure, there are certain nuances to different investments that you should know before putting your money into them. However, investing itself is a pretty straightforward concept. At its core, investing is simply buying something that hopefully goes up in value over time. And luckily for us, there are plenty of resources online to help us understand how the market works. Just remember that investing is a marathon, not a sprint. Take your time to learn about the market and don't feel pressured to jump into things you don't fully understand. One of my favorite quotes is that in the short term, the stock market is a voting machine. In the long term, though, the stock market is a weighing machine. What this means is that in the short term, the price of a stock or an ETF is based on the sentiment of the market and investor psychology. Does the news like it, or do people like it? However, over the long term, the value of an investment will eventually be based on its true value. If a company is producing quality products and services and they continue to innovate and adapt to the changing world, then they will survive and thrive over time. Same thing applies to index funds and ETFs. The point is that we shouldn't put too much emphasis on the short-term performance of an investment because a lot of that is just noise. Instead, we should focus on finding quality companies and ETFs that we believe in and then hold them for a very long time. Myth no. 3 is that investing is risky. Well, that one is kind of true, but only sort of. I think this myth comes from people hearing stories of people who lost a ton of money by investing in sketchy penny stocks or trying to day trade cryptocurrencies. But those are extreme examples of bad investing habits, and they are not good representations of what investing is supposed to be. The truth is that there are certain investments that are pretty safe. For example, large cap index funds and ETFs have seen an average annual return of between 7 and 10% over the last 50 years. And since these are diversified across hundreds or even thousands of companies, the risk is spread out. There will always be volatility in the market, and you might experience some serious losses from time to time. But if you have a long time horizon and you're investing in the right things, then the short-term fluctuations should not matter. We can use the power of compounding interest and time to our advantage if we just remain calm during turbulent times. A good rule of thumb is that if you can stomach the losses, then you should stay invested. Number four is that you need to be able to predict the future. This is definitely a false myth. Nobody has a crystal ball to tell the future, and anyone who claims otherwise is just trying to scam you. You do need to know what is going to happen tomorrow or next week or even next year to be a good investor. You just need to have a good understanding of what you're reinvesting in and why you think it as a good investment. Then you need to have a solid plan and stick to it. Warren Buffett, one of the greatest investors of all time, famously said that he doesn't even like to think about the short-term performance of his investments. He focuses on finding quality companies with strong competitive advantages and then hold on to them for decades. The point is that you do need to be a genius or have access to insider information to be a good investor. You just need to be smart about your investments and have a long-term perspective. Finally, we have myth no 5, which is that investing takes a lot of time. It's true that managing your own portfolio of stocks and ETFs takes a lot of time, especially if you're trying to actively beat the market. But if you're just trying to buy and hold a low-cost index fund, then it doesn't take much time at all. In fact, it only takes a few minutes to set up automatic deposits into your investment account. Once you've done that, you can basically set it and forget it. Of course, you still need to do your research and make sure that you're comfortable with the investments that you're remaking. But after that, the day-to-day management of your investments shouldn't take up much of your time. The point is that you do need to be spending hours every day trying to manage your investments. If you're just buying and holding a low-cost index fund, then you can basically set it and forget it. So there you have it, guys. 5 common investing myths that could be holding you back. Don't let these lies keep you from achieving your financial goals. Remember that investing is a powerful tool that can help you build wealth over time. So don't be afraid to get started. Even if you don't have a lot of money, you can still start investing today with as little as $1. Just do your research. Find investments that you believe in and then hold them for a long time. With the power of compounding interest and time on your side, you can achieve your financial goals. Thank you so much for watching. I hope this video was helpful to you. If it was, please leave me a like and consider subscribing. I would love to have you here. Also, if you want to learn more about investing, be sure to check out the links in the description below. I'll see you again soon with another video. Bye.